The housing market is about to flip. And it's not just because home prices got too high, or because mortgage rates stayed stubborn, or because buyers are tired. The surface level story is affordability. That part is real. But underneath that, something bigger is changing. The balance of power inside the market is starting to move. For the last few years, housing felt like a one-way trade. Inventory was tight. Owners were locked into ultra-low mortgage rates. Buyers had to chase what little supply was available, and in some markets, investors were still powerful enough to shape pricing around the edges. But today, it's very different. Inventory is rising. Homes are taking longer to sell. Large investors are net sellers in a number of markets. And even though the market is not collapsing nationally, the psychology is changing from buy now before it gets worse to wait, maybe I have leverage. That's why this matters. A housing market doesn't need a 2008-style crash to flip. It just needs the pressure to move from buyers to sellers. It just needs more listings, slower demand, and a growing number of people realizing the old rules don't work the same way anymore. So let me break this down clearly, because if you understand what's happening here, you will understand a lot more than just housing. You'll understand where money is getting tighter, where negotiating power is shifting, and why this market may look very different over the next 12 months. Now, very quickly, my goal here is not to tell you to panic buy a house or panic sell one. I'm not here to make some dramatic end-of-the-world claim. I want to break this down in plain English so you can understand what's actually happening, what might happen next, and how to think about it without getting lost in the noise, because a lot could still change. But based on the information we have today, the housing market is going through a real transition. Let me start with the foundation, because this is where people need to get honest. The reason housing feels broken is not just that homes are expensive. It's that the monthly math changed faster than most people's lives did. Realtor.com reported that in February 2026, the national median list price was about $403,150. That was actually down 2.1% from a year earlier, which sounds like relief. But the typical home still spent 70 days on the market, 4 days longer than the year before, and active listings rose 7.9% year over year. That tells you something very important. Prices are no longer behaving like they did during the frenzy, and buyers are no longer behaving like they're desperate at any price. Now layer rates on top of that. ICE reported that when mortgage rates briefly touched 6.04% in early January, affordability improved to the best level in 4 years. But even then, affordability was still structurally stretched, with the national home price-to-income ratio sitting around 4.8 to 1, well above the long-run average near 4 to 1. In plain English, even when rates ease a little, housing is still expensive relative to what people earn. That's the base problem. And here's what people are missing. A market can feel better and still be unhealthy. That is exactly where housing is right now. Slightly better than terrible is not the same thing as affordable. If you're a homeowner who locked in a low rate years ago, you may feel protected. If you're a first-time buyer, you may still feel completely squeezed. If you're a seller, you may still be anchored to yesterday's expectations. And if you're a builder, investor, or lender, you may be looking at a market where demand is soft enough to worry you, but prices are sticky enough to prevent a quick reset. That's why the housing market feels so weird. It is not frozen, but it's not flowing normally either. A lot of people thought the answer would be lower mortgage rates. That was the hope. Just get rates down, unlock affordability, bring buyers back, and let the market normalize. And yes, even small rate moves matter. ICE showed that a short move towards 6% meaningfully improved affordability and put millions of borrowers in the money for refinancing. So the idea wasn't crazy. The problem is that the solution may not be coming fast enough, and even if it does come, it may not fix what people think it fixes. Why? Because rates don't live in a vacuum. The bond market cares about inflation, growth, and risk. The International Energy Agency reported that conflict in the Middle East severely disrupted oil flows through the Strait of Hormuz, with benchmark crude surging by about $20 a barrel to roughly $92 after the outbreak of hostilities. Why does that matter? Because energy shocks don't stay in the energy category. They move through shipping, travel, goods, inflation expectations, and household confidence. So now you can start to see the issue. People were hoping for a clean affordability fix through lower rates. But if inflation risks stay sticky, or markets think inflation risks are sticky, rate relief may be slower, smaller, or more fragile than buyers hoped. And that brings me to the hidden driver in this story. Because the housing market is not just dealing with weak affordability, it is also dealing with a shift in supply behavior. This is where things get interesting. For years, one of the reasons housing stayed so tight was the lock-in effect. Owners with cheap mortgages didn't want to move. Buyers had too few choices. Investors, in some areas, were still competing for homes. That combination helped keep prices firm, even as affordability deteriorated. but based on the information we have today, that pressure is starting to ease. Realtor.com is forecasting an 8.9% increase in active listings in 2026, marking a third straight year of gains, while existing home sales are expected to rise only modestly. Redfin is calling this period the Great Housing Reset, not a crash, but a years-long normalization where affordability improves mainly because wages outpace home price growth and price appreciation stays muted. Redfin expects median U.S. home sale prices to rise only about 1% in 2026, while Realtor.com forecasts a modest 2.2% increase. That is a radically different environment from a frenzy market. Now here's why that matters. Housing flips when inventory grows faster than emotional demand. That's domino number one. Domino number two is investor behavior. CNBC reported that the largest institutional investors are now net sellers of homes, and they have been selling aggressively in some markets for 2 years. In places like Dallas, Philadelphia, and Houston, investors account for a much larger share of for-sale listings than they do of the total housing stock. In Dallas, for example, investors own 9.2% of the housing stock, but accounted for 22.8% of new for-sale listings in the report. That is a local supply story, not just a national headline. Now, to be clear, this does not mean Wall Street owns all the homes in America. It doesn't. CNBC cited Bank of America analysis showing large institutional investors make up only about 3% of the single-family rental market, with most single-family rentals owned by smaller landlords. That nuance matters. But local markets are set at the margin. You do not need institutional investors to dominate nationally for their selling to matter locally. If one group becomes a much larger share of listings in a specific metro, that can absolutely change pricing pressure there. Which brings me to domino number three. The investor strategy itself is changing. Some of these firms are moving away from buying resale homes and more toward build-to-rent partnerships or purpose-built rental communities. That means even when they stay in housing, they may be less supportive of resale pricing than they were during the post-2020 run-up. In plain English, one of the buyer groups that used to help absorb homes in certain markets is no longer acting the same way. That matters a lot when owner-occupant demand is already constrained by monthly affordability. Domino number four is the stress coming from credit and the broader financial system. This is the part people either exaggerate wildly or ignore completely. Reuters reported that Fed Chair Jerome Powell said the central bank is watching private credit carefully for signs of trouble, but he does not currently see it as having the makings of a broader systemic event. Why does that matter for housing? Because if credit conditions stay tighter, refinancing stays harder, deal-making stays slower, and more financial players prefer liquidity over risk, then housing demand does not get the same easy money support it got in the past. Also, if certain funds, firms, or investors become more defensive, they may decide to sell assets, reduce exposure, or stop expanding in markets they previously supported. The simple version is this. When money gets more cautious, housing usually feels it. Domino number five is regional fragility. ICE reported that more than 1.1 million borrowers ended 2025 underwater, the highest level since early 2018, with negative equity concentrated in more recent vintages and several southern markets having more than 1 in 10 mortgaged homes underwater. National equity is still historically strong, but the cracks are not evenly distributed. That is a huge deal because people talk about the housing market like it's one neighborhood. It's not. There are markets with stable demand, constrained supply, and strong labor conditions. And there are markets where price declines, soft rents, investor selling, and more fragile recent buyers can all reinforce each other. That's where things flip first. So let me simplify this with one basic rule. Housing is still supply and demand, but now the supply side is changing faster than people expected. For years, buyers had to compete with each other. In a flip, sellers start competing with each other. That's it. That's the law. When inventory rises, homes sit longer, investors list more properties, and buyers still can't comfortably afford the monthly payment, sellers lose power. They start cutting prices. Maybe not in every zip code, maybe not all at once, but the negotiation shifts. Seller concessions become more common. Builders offer incentives. Resale owners who thought they could name their price start adjusting to what buyers can actually pay. That is what a flip looks like before the headlines fully admit it. And once that happens, different groups experience the market in very different ways. If you are a first-time buyer with stable income, strong credit, and patience, this flip could be good news. More inventory means more choice. Slower sales mean more negotiating room. Seller concessions can help with closing costs, rate buydowns, or price reductions. The point is not that homes suddenly become cheap. The point is that buyers may finally start getting some leverage back. If you are a homeowner with a low mortgage rate and no need to move, this may be mostly noise. Your house is still where you live. But if you were mentally counting on endless appreciation or planning to live off your paper equity, this is where you want to be more careful. Equity feels real until the market decides to test it. If you are a seller, especially in a softer market, this is where timing, pricing, and realism matter a lot more than they did 2 years ago. The worst thing a seller can do in a flip is price for the market that no longer exists. If you are an investor, this is where discipline matters. Not every dip is a deal, and not every market is weak for the same reason. Some places may offer real opportunity if inventory rises and pricing softens, while long-term housing demand stays intact. Other places may be cheap for reasons that get worse. And if this continues, what should you watch next? Watch inventory. Watch days on market. Watch seller concessions. Watch where investors are listing disproportionately. Watch whether rate relief is durable or temporary. Watch regional divergence, especially in parts of the South and West that were hit harder by post-pandemic volatility. And above all, watch monthly affordability, because that is still the heartbeat of this market. So what's the smart viewer lens here? Don't panic. Pay attention. Don't blindly wait for a crash, and don't blindly assume housing always goes up the same way everywhere. The market flipping does not automatically mean a national collapse. It means power is moving. It means the easy assumptions are breaking. It means the seller-friendly environment that defined the last stretch is weakening, and the people who understand that early will make better decisions than the people who react late. Here's what people are missing. A flip is not always loud at first. Sometimes it starts with inventory quietly rising for months. Sometimes it starts with homes taking longer to sell. Sometimes it starts with investors becoming net sellers in more markets. Sometimes it starts with prices staying flat, while inflation and wages do the resetting. That's still a flip. It just doesn't look like the dramatic movie version people expect. So if you're buying, think in terms of monthly payment, local supply, and negotiating leverage. If you're selling, think in terms of realism, not nostalgia. If you're investing, think market by market, not headline by headline. And if you're a homeowner, don't turn your home into a slot machine in your head. A house is shelter first. If it builds wealth over time, great. But the people who get hurt in transitions are usually the ones who mistake paper value for guaranteed value. That's where things stand based on the information we have today. Inventory is rising. Prices are softening in some places. Affordability is still stretched even when rates improve. Institutional investors are no longer the same kind of support they once were in some markets, and the market is shifting from one ruled by scarcity and urgency to one ruled more by patience and negotiation. If you got value out of this video, the best thank you is a referral. Share it with a friend, family member, colleague, or fellow investor who's trying to make sense of what's going on in housing right now. And if you want more breakdowns like this, subscribe, because this market is changing in real time, and the people who learn to see the shift early are the ones who usually make the smartest moves later.